Chapter 13, we are going to jump into stockholders' equity once I get this started up. All right, so Chapter 13, stockholders' equity. Let's have a chat. Okay. We're going to do a lot of good stuff. All right, sorry. You want to look at these? Pause the video, pause the video, pause the video. Here we go. All right, what are corporations? All right, their corporations are a separate legal entity. They are different than partnerships. They are different than S corporations. We're talking about a C corporation here. Um, they act like anybody else. Okay, they are taxed. They have, well, unlike us, they have an indefinite life, right? When Walt Disney died, the Walt Disney Corporation didn't die with him, but partnership would have, sole proprietorship would have. Corporation kept going. Okay. Uh, okay, so we have separate legal entities. There's a ton of owners, right? If you buy a share, even a fraction of a share, you are an owner in a company. But the owners do not have any liability, and they do not have mutual agency, which means they cannot do anything. All because I own one share of Nike stock, I can't run to a college of my choice and enter into a contract. All right, and then they typically have capital accumulation. But the biggest issue is that they have their taxation. They are taxed before they are distributing money to their owners, and even when they do distribute the money to the owners, it's not tax deductible. And the owners who get the distribution get taxed on that money again. So you're going to hear a lot of people in the political realm say, well, um, you know, because they're called capital gains or they're called, whatever, dividends. Well, oh, they got dividends, and those are only taxed at like 15% instead of everyone else is taxed at like 30% for their income. Uh, First of all, I'm kind of against any kind of tax on income. I don't think you should tax income at all. But if you do and you tax it twice, the second time should be a little less. And that's the whole idea here. You have these individual corporations, they are taxed. The remaining amount is distributed to the owners, and that money is taxed by the to the owner, whoever got the dividend. So that's why that happens. So when someone says, oh, they're not paying their fair share because they receive dividends, entities like individuals, uh it'd be like if you went and earned some money and you get taxed on that money that you've earned, and then they tax you again because you gave it to your wife or significant other or whatever, stayed within the household, but you just gave it to someone else, and like, okay, well, you gave some of that money to them, so now we're going to tax that again. Just it's not a good thing. Here's your advantages and disadvantages. Okay, advantages for corporations are kind of stuff we talked about. Continuous life, limited liability, no mutual agency. Disadvantages are, though, that ownership and management are very different, very separated. Even if I have one share of Nike stock, I can't go to the Nike Corporation and start telling them what to do. Okay, even though I'm an owner, I do not have the right. Okay, but I mean, we do have, if you're a common shareholder that has voting rights, you get to vote for who the CEO is. But once you vote him in, the CEO runs the company, and you're done. I mean, you could, if you were influential enough with the number of stocks, you could certainly push for certain things to happen. But ultimately, it is the CEO that runs the company. Okay. All right, so let's talk a little bit about stocks and what they are, and kind of we have three different types of like concept stocks. Okay, like when we're talking about stocks, the company creates its articles of incorporation. That's what creates the company. With that, they indicate how many shares that the company will ever have issued at any point. So that's called the authorized stock. This company is authorized to issue up to this amount of stock. We're talking millions, sometimes billions of shares that they will put in the articles of incorporation for the reason that you don't know what's going to happen in 20, 30 years. And to change your articles of incorporation to reflect it, especially once you get going and you get your groove, it's very hard. And so they're going to put in a whole lot of stock. Okay, they're going to say, so like, let's say I'm a startup company that's incorporating, and I'm saying, or like I'm doing my initial public offering, or I'm creating myself as a company. I'm going to say at any given point, my company will only have up to 27 billion shares of stock, okay, of common stock. And they even go into different things like class stocks, like class A common, class B common. I mean, there's all kinds of different types of stock. We're going to keep it basic in this course, but just know that that kind of thing is an issue, and that you have to remember that. Issued stock. So once you create how much you could ever have at any given point, now you're going to say, all right, well, now we're going to issue some stock. And when you issue it, it means you have a public offering, or you sell it to some place who's going to sell it as a third party or whatever. The bottom line is that whatever the company sells at any given point goes into the category of issued stock. But the company could buy some of those stocks back. Those stocks are still considered issued that they've bought back, but they have control over it. So any share of stock the company does not hold is considered outstanding stock. So those are the three kind of things we're looking at when we're talking about whether they're authorized, issued, and outstanding. A lot of times the issued and outstanding could be the same number, but very seldom, very rare, you ever going to find a company that has issued every possible share of stock to where authorized and issued are the same number. Okay, you're always going to have some in the back pocket, ready to issue if you need to raise capital for any reason. And that's the point of issuing stock, is to raise capital. Okay, that's why it's called capital stock. It's why it's, things like that. But stockholders back in the day were issued stock certificates. I've owned some shares of stock. I have never once held a share of stock in my hands, but here's what they look like. This is a Smart Touch Learning stock. I don't even know who this person is. It could be just made up. I don't know. But this is what it looks like. Okay. You'll have some signatures, your president, your treasurer of the time this stock was issued, the amount of shares, the serial number, you have the company name. It's going to say issued to the stockholder themselves, things like that. And this is just an example. They vary. It doesn't have to look like it. You can Google what does a stock look like, and that'll tell you. This is a good analogy, or good graph or whatever, to kind of see the blue circle incorporates all the stock. It's authorized. This is the maximum number of shares that the company at any given point could ever have issued at any point. The blue color represents stock that the company has not yet issued. So authorized stock incorporates all of it. The what is that? Orange, the second circle inward, the middle circle or whatever, the orange one. That's the issued stock. So not only is it authorized, those ones, but it's also issued. Okay. Um, they may be held by the company, they may not be held by the company, but they've been issued. They're active somewhere in the market, owned by somebody, whether it's the company themselves who's bought it back, or whether it's not, and it's company that or other companies or individuals who bought the stock. And that that orange difference from issued to what's actually outstanding from the inner thick circle represents stocks that have been issued, that are still active, but that the company has bought back. Okay. So any difference between issued and outstanding is stock the company bought back. Then the inner circle, the red one, is the outstanding stock. It is both authorized, they have been issued, and the company does not own them. They do not have them in their coffers. They have not bought them back. These stocks are out there. Some Joe Schmo has them. Some mutual fund has purchased them. Whatever the case is, they are not in the control of the company. Here are your stockholders' rights, typically basic rights. Okay, and this is if you own, because you can own stock and not have voting rights, but generally speaking, you're going to have voting rights. One share, one vote. Dividends, you can get a dividend. So if they say we're going to give out 50 cents per share dividend, you're going to get 50 cents for every share you own. Liquidation, you are literally the last person to get anything after everybody else has been paid. You are literally it. And then preemptive right, the stockholders have a right to maintain their portional ownership, meaning that if the company ever decides to go out and sell more stock, they have to first give you the right of first refusal. So if you own 20% in a company and they're going to go out and issue 100 shares, they got to offer you the 20 shares to keep your 20% ownership. And the reason for that is because sometimes in the past they would if they didn't like an owner, they'd try and issue more shares to dilute that person's ability to vote. Now legally they can't do that. All right, here's two kinds of capital stock. You got your common stock and your preferred stock. Common stock is your basic ownership stock. Preferred stock is more like an interest stock. I say it because it kind of acts like interest. You get a stock certificate. It's got a dollar amount affixed to it, but you got a percentage that's going to pay you a dividend, and it's going to pay you the dividend before common stock gets anything. So it's possible. Um, Par value is the dollar amount fixed to each common stock or any kind of stock. Par value can be as low as 1 cent. In fact, I've started recently seeing shares of stock that are 0.001 cent. I'm sorry, $0.001. So 1/10 of a cent. Um, the reason they want them so low is because you can't sell stock below its par value. So if you have $10 par value and for some reason your stock price dips below $10, so your par value is 10 and your actual fair market price is 9, you can't sell any more stock until that price gets up. So it's kind of a ding, and so they'll issue stock at 1 cent. You can't go below 1 cent, at least theoretically. Penny stocks do though all the time. You can have ones that don't have a par value on them, and then there's not an issue. I think that was probably a response to that rule or law that says you can't issue below par. And then you have a stated value stock. It's just no par value that has been assigned an amount similar to par value. Our focus is going to be par value stock. I mean, we'll go over all of it stuff, but we'll do. New stockholders equity or new equity section. We used to call it owner's equity. We'll now call it stockholders equity section. Instead of the owner's capital, we're going to have paid in capital, which represents the stock and any additional amount above par value, which is called additional paid in capital. And we're going to have retained earnings, which represents the money that it was earned by the company and not distributed to the stockholders. We'll have other areas too where we're going to talk about the stock and how much how like other stock that goes into the owner's capital. So you have the retained earnings, you have the you also have treasury stock. Anyway, we'll go into all that. Sorry, I'm kind of just relaxing here. I'm kind of tired. All right, journalize the issuance of stock. All right, let's do that. Let's learn how to do that. It's kind of easy. You're getting money and you're issuing stock. Now, what happens? It just tells you how it happens. You get an underwriter, they'll tell you how much it is, or they'll buy it and then sell it for you, whatever. Most of the time, you're going to see, because this is academic, we're going to keep it at like $1. We may even do $5, $10, whatever. Point is, we want you to understand kind of how that works. But like I told you, most companies, it's stock is a cent. Got me my Dr. Pepper going, so I got to put my lid on it so that I don't lose any drop of that luscious taste. Okay, so yeah, we already talked about that, so no big deal. All right, here's your journal entry. Whenever you issue stock, you can take the per share, the par value per share, multiplied by the number of shares. Okay, that's going to be your common stock. Now, if you have $1 par value and you sell that for $1 par or $1 per share, your cash and your common stock are going to be equal. But what happens if you sell or issue stock higher than that? Then let's say you're going to sell them for $5 per share and you sell 3,000 shares. Now your cash is $5 times 3,000 shares. That's 15,000. Your common stock is still going to be the same. It's going to be the par value $1 times the number of shares, 3,000. Your paid in capital is what is in excess of par. Now you can either take 15,000 minus 3,000, come up with that, or you can take the per share that you sold it for, subtract out the par value to get the number 4 and multiply by the shares. Either way, you're going to come to the same number. Stockholders equity section. You have here's what it looks like. You have your paid in capital, your common stock, your paid in capital, total paid in capital is going to be all added up. Then you have your retained earnings. Now, retained earnings, I think we're going to talk about it later on, but just retained earnings acts like your old owner's capital account. You have your beginning balance. Except you don't do any additions. It's just beginning balance plus net income minus what's effectively owner's withdrawals, in this case dividends, equals ending balance. And there's a few other little things that might hit the equity, or sorry, the retained earnings, but for the most part, that is your formula. When we issue no par common stock, we're basically just going to, we get $1, $5, whatever the case is. If we're selling 15 shares in this case, well, hold on a second. Let me just read it there. Assume that the company issues 15,000 shares for $1 and 3,000 shares for $5. Okay, fine. So either way, we're just going to say cash is the same amount in both situations. We're going to credit the common stock no par value. In this case, we have $30,000 of no par value common stock. When we look at the stockholders equity section, you're just going to have the paid in capital, or you're just going to have common stock indicating that it is no par value. And then we have $30,000 issued and outstanding. And we have, or issued, I should say, because we could own it still. Retained earnings is still at 30,550. Let's talk about stated value. Okay, stated value is going to be pretty much the same thing. You're just taking the stated value, which is $1, multiply by 3,000 shares to get the $3,000 of your common stock. You're collecting $5 per share, so you're getting 15,000. The amount that's in excess is going to be in excess of the stated value this time for common stock. Now you might issue common stock for assets that are other than cash. Well, whatever you do, you're just going to debit whatever it is, and you're going to use the market value of the issued stock or the asset received, whichever is more. Okay. It's got to be clearly determinable, like furniture. If you're getting brand new furniture from a company and you're giving them stock in exchange, they have a cost of that furniture. You got to record it at that cost. Otherwise, you can just use the value of the stock you're giving them if you can't determine that cost. All right. When we issue preferred stock, this is how I said it's kind of like interest. Okay, you got 1,000 shares. It's going to have $50 par value at 6%, and we issue it at $55. Great. So our journal entry to record that will look like this. Our debit's going to be 55,000. Our credit will be to the preferred share with the par value times the number of shares. At this point, it's 50 times 1,000, which is 50,000. The excess is 5,000. Or if you just take the difference in the price, 50 to 55, the $5 multiplied by 1,000, that'll give you $5,000. And here's your stockholders equity section. You're paid in capital, you have your preferred stock. Paid in capital, you have your common stock. This one's $1 par value. They should have thrown them all in there. Like throw in the no stated value, all that other stuff. But anyway, but they don't. But anyway, you're going to need to get to know this very well, as well as the statement of stockholders equity that we'll do instead of the owner's equity. All right, let's learn about the purchase and sale of treasury stock. Treasury stock is the company buying its own stock back, right? So bottom line is we have, sorry, I got this adjustment arm now. I want it to be a little higher because there's a little play in it. Anyway, we bought our own stock back, and the reason for that is it could be anything. It could be that we believe that our stock price is too low, and we're going to buy it back, and then we're going to sell it higher. And we could be trying to make the stock price go higher, less stock on the market. If there's a demand stays the same, economic theory says that the price will go up because you have the same demand but lower supply. If somebody recognizes that maybe you have a ton of equity in your company that they want to tap into and steal from you, basically, they could try what's called a takeover, hostile takeover, which is to buy up to like 51% of your stock. And if they do that, then they basically take over your company. It's called a hostile takeover. To avoid that, you can buy some of the stock back so to make sure that you maintain at least prevent somebody from getting 50%, but at least maybe even having 51% of treasury stock would be a way to prevent that from ever happening. And remember, you have to have the preemptive right. So even if you're trying to issue stock to prevent that, you still have to offer all the current owners the same percentage. So, and if you offer it and some of them say, no, I can't afford it, then the company that's trying to buy you over will be happy to take that off of their hands. So, and then you can reward valued employees with stock. I don't like that term valued employees because I know that stock options aren't typically given to your line, your brand new employees and stuff, and they're just as valued. They should be at least. Granted, yeah, if someone's been around for a while, okay, they're valued. They've been there a while. But typically it's more your executive officers, your CEOs, CFOs, managers, things like that. Keep pushing my keyboard in. I can't hit the button. Okay. So treasury stock, normal balance of the debit, which means it's a contra equity account. And it makes sense because we're going contra to the common stock with this. Treasury stock is we're buying back what was issued as common stock, and we're not retiring it. If we retired it, then it would just go away, but we're not doing that. So we got to put on the retained earnings to a reduction to our equity section. I said two, I meant beneath the retained earnings. It does not have a par value recording at whatever price we paid for it. Here's an example. If we paid $5 per share, 1,000 shares, this is what it looks like. Debit to treasury stock, credit to cash. Now the kicker here, if we sell it at cost, we just do a reverse transaction or, reverse to what we just did. If we're selling it again for the same price we bought it, we're going to debit cash, credit, treasury stock again. But if we don't, this is kind of the odd thing about it. We're going to have an additional paid in capital from our treasury stock. So if we sell it for $6 per share, we're going to get, we bought it for $5. We're going to reduce it based on the $5 we paid for it, $5 per share times the 200 shares. But then we have this additional paid in capital, or it's paid in capital from treasury stock. That's a normal equity account. So you have your treasury stock that's a contra equity, and then the paid in capital related to it when you sell it as an equity account. So it's kind of a unique relationship where you have the main account as the contra, and then it's additional paid in capital as an equity account. So be sure to be mindful of that. If we do end up selling below the value of it, then we will dip into our paid in capital. And if we dip into it too much, this is an example of not dipping into it too much. But if we do another one, this is where one of those rare things where we're gonna have to dip into our retained earnings. And that's why I said most of the time our retained earnings is going to be our net income, and then our credit to, or then our withdrawals will be dividends. But sometimes when we do these treasury stock transactions, we may need to dip into retained earnings as well. So here's our partial balance sheet of the stockholders equity section. Now we're going to throw in there our treasury stock. We see that there as a contra account, subtraction of 1,500. Our retained earnings from prior ones we've seen is lower now. I wish, and I don't know why company or these slides don't have it. They should show one where it shows the treasury stock as the additional paid in capital for the treasury stock as well. They don't do that here. I wish they would, but they don't, because that would be a normal balance, right? It would be a positive number in the stockholders equity section. So when we sell it, treasury stock is part of the issued, but not part of the outstanding, because it's issued, but if we bought it back, it's not outstanding. That means when we do a dividend, if we own treasury stock, we do not pay ourselves. If we own the stock, why are we going to give ourselves a dividend to get taxed again? We're not going to do that. So we only pay dividends on outstanding stock. Okay. So when we sell it, that's where we're pulling it out of the treasury stock. If we decide to retire it, then all we're going to do is, canceling the stock certificates. Retired stock cannot be reissued. And to purchase previously issued stock for retirement, we debit the stock accounts and credit cash. Cool. So basically reversing that entry as though you didn't ever issue it. All right, let's talk about dividends. Dividends are the whole reason why a lot of people invest in a company. Sometimes you'll get people who invest in a company because they believe in the company or they want to be part of the company. For the most part, if you're doing it for retirement, if you're doing it, you want dividends. You want dividends and you want growth. Those are the two things you're going to want. So dividends, they have 3 dates. Date of declaration is when you declare that you are going to issue a dividend. Date of record is simply those who hold the stock at that time will receive the dividend checks. It is an administrative date, and there is no journal entry associated with it. Then the date of payment, the date of declaration, going back to the first one, we create our liability, and on the date of payment, we satisfy that liability. Okay. So on May 1st, Smart Touch Learning declares a 5-cent per share cash dividend on 22,700 outstanding shares of common stock. Take that dividend per share amount and multiply by the outstanding shares. In this case, it's going to be $1,135. You're going to debit your cash dividends, credit dividends payable. Okay. This is where some books do it differently than other books. Other companies do it different than other companies. Dividends come out of retained earnings. Some people want to track the dividends for some reason in a special account, maybe. I don't know. But you're going to debit this cash dividends. It acts as a contra equity account, but I don't particularly necessarily care for it. But in Pearson, you're going to be doing this. My experience is you're going to debit retained earnings. You're just going to take it right out of retained earnings because that's where it's coming from. And then you have your dividends payable for the common stock as a credit. On the date of record, which is May 15th, there is no journal entry. And then on May 30th, when you actually pay it, you're going to debit the dividends payable and credit cash because you're actually making that payment. This is why I don't think that you really need to do the cash dividends because you're going to close this at the end of the accounting period to the retained earnings. It's just another step later on. You just debit the retained earnings from the get-go. You cut this process out. I don't think that debiting retained earnings when you make the declaration is a bad idea. Everything I've seen is you can do that and it's fine. So why make an extra step? But you can, and that's how Pearson wants you to do it. So we're going to do it Pearson's way this time. If we're paying a dividend on preferred stock, let's talk about preferred stock a little bit. First of all, you're going to have two different types of preferred stock. You're going to have cumulative, you're going to have non-cumulative, and it depends on which one and the timing on how that works, on how much is going to go to each one of those different types of preferred stock. So in this case, if we have 1,000 shares outstanding of $50 par value common stock that says you're going to get 6%, you're going to calculate it as taking the 1,000 shares times the par value times the percent. So according to this example right here, $3,000, and it's an annual thing, $3,000 is owed to preferred stock every year. Now, depending on if it's cumulative or non-cumulative will depend on whether or not you're going to have to deal with something that's called dividends in arrears. Dividends in arrears is an amount owed to prior period preferred stockholders who did not get this annual payout. And so let's talk about that. Cumulative means that every year that it does not get paid to the preferred stockholders, it's owed to them. Non-cumulative, if you don't get it that year, tough luck. But if any dividend is declared, you will get yours before the common stock do. That's the whole point of it. Preferred stock means you are preferred over the common stock in the sense of dividends. So let's look at an example here. Greg's Games Inc. has 1,000 outstanding shares of 6% $50 par value cumulative preferred stock, meaning if we don't get our money this year, we are owed it. In 2025, the business did not pay any cash dividends. But on September 6, 2026, Greg's Games declared a $50,000 total dividend. So how much did we owe the preferred stock? Well, you take the 1,000 times 6% times $50. That's $3,000 per year. In 2025, we didn't get it paid. So in 2026, instead of just paying 3,000 towards the preferred stock, we're going to pay them the full 6,000. That was 3,000 owed to them the prior year that they didn't get, and the current 3,000 that we owe them this year, for total 6,000. So the rest, 50,000 minus the 6,000, will go to the common shareholders. Journal entry will look like this: debit to cash dividends, credit to the dividend payable for common, and dividend payable for the preferred. On the date of payment, it'll be a debit to the dividends payable common, dividends payable preferred for the 44,000, 6,000 respectively, and a credit to cash. Okay, if it is non-cumulative, we don't care that we didn't pay them in 2025. Sucks to be them. We're just paying it for the full year this year. $3,000 to the preferred shares after a $50,000 cash dividend was declared. We're going to debit or sorry, not debit. We're going to reduce the total dividend by the 3,000 we're giving to the preferred, and the remaining amount goes to the common shareholders. Now, what is a stock dividend? What if the company does not have any money, or they just don't feel like it, or they just want to give out stock? I mean, there's a whole bunch of reasons why they could. Okay. Continue dividends, but conserve cash, reduce the market price per share of its stock, reward investors, yada, yada. Small stock dividend is going to be less than 20%. To 25% of issued and outstanding stock. Any problem I give you for this is going to be obvious. Okay, it'll be like 10%, 15%. Large stock dividend can be anywhere 20 to 25% greater than stock. So it could be 50, 75, it could be 100%. That's a large stock dividend. Depending on the type of stock dividend will depend on our journal entry to record it. Same three journal entry or same three dates are matter: declaration, record, and distribution. Truly on a stock dividend, I would wait until afterwards. Cash dividend, maybe not as big deal, but I would want to keep the stock because it's almost like a stock split. Not quite, but similar. You just get more stock. So instead of doing a cash dividend, we're going to do a 5% common stock dividend on the 2 million shares issued and outstanding. So see what I'm saying? Like, it's not going to be anywhere. It's going to be like 21%. Which one are you going to do? 5% common stock dividend. So we're going to take the $50 per share times the 2 million shares times 5%. That's our debit to stock dividends. Our credit to common stock dividends distributable will be the per share amount, which is the $1 per share times 2 million shares times the 5%. And then we're going to credit the rest to the excess paid in capital in excess of par. That's for a 5% stock dividend. Once we pay it, we are going to debit the common stock dividend distributable, and we're going to credit the common stock $1 par value only for the amount of the $100,000. Once we book that additional paid in capital in excess of par, it stays there. It's not, nothing else happens. Okay. Recording stock dividends. Here's your T accounts. You can look at your journal, your ledger accounts. Okay. Here is your balance sheet before and after. Notice stockholders' equity does not change. Stockholders' equity does not change in a stock dividend. That in a small stock dividend, that's the point. Okay, you're just basically creating new stock, not creating. I mean, it's still within the authorized amount. You're just issuing these stock as a reward for being stockholders, and you just couldn't give them cash. Okay, it's the only difference. Now, what if it's a large stock dividend? Here we got 50% of the market value. Now we're not so much worried about all the ins and outs, but we are still going to take 50% times and this is factoring in the fact that we just did a small one. So we're going to do 2,100,000 shares times the 50% times the $1 par value. And then we're just crediting the common stock dividend distributable. We're not going to deal with the additional paid in capital at this point. It's just what the par value is on a large stock dividend. So debit the common stock dividend distributable on the date of payment and credit the common stock for the $1 par value for the same amount. Stock splits are relatively fun. Okay. We're going to just basically take one share of stock and we're going to split it in half or more. And what it does is it's going to make more stock issued, but it's going to reduce the par value of the stock and thus change the market value per share. It should reduce it by whatever percentage you're doing. You can also do reverse stock splits, which suck for the investor. I had a reverse stock split once in some of mine, and it basically was the worst. Okay, they did it on purpose, and I know why, but well, it's neither of that. All right, so assume that Greg Gaines has 3,150,000 shares issued and outstanding of $1 par common stock. The market value is $50 per share. Greg's Gaines affects a 2-for-1 stock split. So what we're going to do now is we're going to take, instead of having $1 par value and 3,150,000 shares of stock, we are going to have 50-cent par value and 6,300,000 shares of stock. So we cut the par value in half and we doubled the number of shares that were issued and outstanding. The cool thing about it is you don't have to do a journal entry, and it's just kind of basically changing your balance sheet, your equity. Okay. The stockholders will get these additional shares, and in theory, the market value should go down from $50 to $25 a share. In theory. if you're killing it and you're doing it because your stock price is so high, I mean, even though it might go in half, it might still increase. And that's a bonus to the people who are holding that. Notice too, really quick, your stockholders' equity section, the common shares don't change. Whenever you're dealing with these stock dividends and you're dealing with these stock, the stock splits, you're not really impacting much as far as the company's concerned. But investors love stock splits. They love stock splits. They love getting 2 for 1, especially 2 for 1. This is a 2 for 1. It can be a 3 for 1, 4 for 1, 5 for 1, 100 to 1. Depends on what's going on. So dividends and stock splits in the accounting equation. You can look at this, pause this, and see what the impact is. But you're going to see that stall smock split. Small stock dividends, large stock dividends, and stock splits, there's no impact on the total equity in the stockholders' equity section. Stock split doesn't impact anything. You can see going down there. And just, pause the video right now. Take a look at this. It's not a bad thing to kind of have in your mind. Anyway. All right. So prepare a corporate income. Okay. Before we get to this, I want to give you your word. Your word is Jim. 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 Juliet, India, Mike. I'm trying to think. Is it Juliet? Or am I thinking the old police names? Juliet. I think it's Juliet. Juliet. Anyway, JIM is your word. Please put that in to the quiz that you're supposed to do, and that'll be your points for this. But keep watching. We're going to still talk about this. So here is your income statement, right? You have your regular continuing operations up there. You have some special items, discontinued operations, and you have your earnings per share information. So, and then you have your earnings per share that's going to be broken out from your continuing operations, your discontinued operations, and your net income. Okay, three different looks. You also have, as far as earnings per share goes, diluted earnings per share, which will take in effect any stock options and other things that could be exercised as far as the number that could be down the road. But we're not getting there. Continuing operations. I'm going to just kind of breeze through this. This, I think, is more of the appendix kind of stuff. But you have continuing operations, basically what it is you're doing. Okay. If you're a manufacturing company, you're manufacturing Dr. Pepper, you're making Dr. Pepper. That's what you do. Okay. Discontinued operations would be as if they did a Dr. Pepper theme park and realized that was a stupid idea. And then they discontinued having the theme park. They discontinued the operation. So they're going to basically stop doing the park. And, they're going to take the income that you got from all that and then you're just done and you won't see it again. So earnings per share is definitely a very important statistic, whether it's a net income or net loss. You want to know how much each share is basically earning related to the income of the company. And here is how we report the equity on the corporation. You have your statement of retained earnings. This is what I told you about earlier in the video. You have 0 retained earnings at the beginning, your net income. You add that to it, your dividends declared as a subtraction, and you have your retained earnings. Okay. Now, again, you can when you're doing your treasury stock transactions, you do hit your retained earnings. That could also impact here, and you'd have that as a different line item on this, but typically, it's maybe not as common. All right. Appropriations of retained earnings could be something where you restrict it because of bank requirements and things like that. Prior period adjustments. If you realize something was wrong in the prior period, you can make an adjustment in this period to show that you're accounting for the error. In this case, it is an error. Okay. You have to make the prior period adjustment. Here's an example of that. This is good stuff, information to know. I don't necessarily test or give you homework on prior period adjustments, but it's something you should be aware of. Statement of stockholders' equity. Again, this is what you want to understand. You're going to show your beginning balance, any prior period adjustments, which here shows you a couple. You're going to have some various transactions that may impact some of them, but not all of them. And then you're going to have your ending balance. So, for example, you have your common shares there. You have your beginning balance. Then you just have your balance as of January 1st, which there was no prior period adjustment for. And then you have nothing that impacted it the rest of the year. You have your beginning balance is the same as your ending balance. But you do have retained earnings. That one's going to typically fluctuate. And if that's the only thing that fluctuates, your total stockholders' equity will still fluctuate. But if you have a common stock issuance during the year, then you'll have that as an impact to the common stock. It's just whatever happens during an accounting period. Earnings per share. I'm sorry, I kind of went through that fast, but we're evaluating business performance using this, so we want to know like what amount of money is attributed to each share. If you have a negative amount, you had a net loss. That's not a good thing, obviously, but typically the higher the earnings per share is, the better. Okay, better. It's a good thing. But again, it could be you can be too good. I think if you were like up to $500,000 per share, holy crap, your share price is probably through the roof. You probably should do a stock split. Maybe like 1,000,000 to 1 stock split. Okay, sorry if I'm confusing you. Just ignore what I just said. Here's your earnings per share. As an example for Pepsi Company, you can pause the video and take a look at it. Number of shares outstanding, you can see that there's a difference by about 3 million, I think. Yeah, 3 million from 2020 to 2021. So we can deduct that we issued 3 million shares during 2021. Looking at this information, total stockholders' equity went up by 3 billion. Sorry, a little less than 3 billion, about 2.6 billion, I guess. So your earnings per share is $5.51. That's pretty good. Pretty good. So maybe your price earnings per share. Take your stock price per share divided by your earnings per share. That's a good one if you want, but it could, high and low could mean different things for different investors. A high price to earnings ratio can suggest that your company is making or that your stock price is really high, your earnings per share is really low. It could mean a lot of things. It may not be that it's a really good thing to have that number high. If your earnings per share, or if your stock price per share is really low and your earnings per share is really high, that could mean your number is really super low. That could be a really good thing. So all because these numbers are big doesn't necessarily mean that that it's that you need to suddenly run off. So the second bullet that says this ratio tells investors how much they should be willing to pay for $1 of the company's earnings. So we're saying basically, hey, we should pay for $1 or for $31.53 per $1 of earnings. That's what this is telling you. I'm looking at it more from a breakdown standpoint, because your earnings per share is going to take your earnings divided by your per share, then your cost per share. So you're basically you're looking for cost per earnings as you eliminate the share aspect of these numbers. So cost per earnings is what this really could be called. And I guess price to earnings, that's basically saying that. But either way, the higher number, I guess, would just show that people are willing to pay more for $1 of earnings than if it's lower. I would think that if their per share, their earnings is high and their per share was low, I don't know. I think I would like that. All right, rate of return on common stockholders' equity. How much are you getting off of your equity? Okay, is what we're looking for here. There's our rate of return here. In this case, it looks like Pepsi Companies was 51% or 0.51. Your formula here, and I recommend you write this down and always have it with you as you do homework and stuff. But basically taking your net income minus any preferred dividends, and then dividing that by your average common stockholders' equity. So you're focusing on your income that is distributed over the average common stockholders during the accounting period. So the higher the net income, the better. So I would say that the percentage that's higher here is going to be a more income allocated to each common stockholder than if it was a lower percentage. So all right, anyway, you guys have a good one. That is the end of this slide deck. So if you have any questions, you know how to get a hold of me. And I recommend that you put that word in, like I said, and we'll see you in the next video, guys. Have a good one.